Hello and welcome to the Lending Podcast. We're excited to have you listening to us or watching us. This is JB, Guru of Mortgage. I am Jeff Jones, and we are here from Austin, Texas. Provide you good information, make your good decisions about home buying and what's going on in the market. We got a good episode today where we're kind of shedding light, I think, on a trend that happens a lot, especially with social media, with marketing material, and that is the mortgage calculator. So what are we talking about on a mortgage calculator?
Well, we see this, we see it probably every day where there's just, quite frankly, bad math. Bad math happening out there, right?
And it steers you wrong.
It can steer you wrong.
Oh my goodness.
Well, and I think the overall concept here is there's not just one mortgage calculator, one size fits all, right? Like every single individual situation is different. Our credit scores are all different. Our financial situations are all different. The loan types are different. The other day I was talking to a client, we had a video conference going, and I was showing them all the interest rates. I think we've touched on this on the show before, and there are 40 different interest rates. And they had no idea. They were like, we've never seen anything. We didn't know you could get 4% rate today versus 8% or 7%, or what's the average. And so what happens out there, I think, with these mortgage calculators is it automatically takes in what's the average rate right now.
Right.
And again, the average, I always say you can put your head in the freezer and your feet in the oven, and on average, you're comfortable, right?
Yeah.
So this concept of an average, it doesn't fit everybody, right? So take the average today, 6.9, 7%. Here we are, beginning of June 2025. Let's just call it 7%. So you stick in a 7% rate. Then it automatically funnels in some other components of your payment. It automatically calculates an estimated property tax number, an estimated home insurance number, estimated mortgage insurance number, and voila, you've got a payment. And guess what? You might be excited about that number and say, oh, well, I can make that payment. Or you might say, well, that's too much. I'm going to hold off. I'm going to wait for rates to come down. And this is the problem with the one-size-fits-all calculators, because there are so many different ways to structure these loans. And we were just talking a second ago about the concept of buy downs and permanently buying down the interest rates. And so if you stick in a 7% rate and your payment spits out $4,000 a month, and you say, oh my gosh, that's too much. I don't want a $4,000 a month payment. I would do $3,000 a month. Well, guess what? You can get there in most cases. Yes. How do we get there? We move some levers.
Yeah, right? And what's hard is it usually comes with good intentions that people are providing. Here's your estimated payments on these homes, whether that's a website that's listing it, or it's just somebody making a social media post about what payments look like on a home. The hard part is what you're saying is actually true. As lenders, we're talking to clients to get them pre-approved for a property. If we have a specific address, the payment options are all over the map. Like you said, 40 different rates. You can't put that on a payment calculator.
No.
Plus, is the seller offering concessions, or are you asking for concessions? Because that can greatly change your monthly payment. And what we want to do on this episode is say, understand that a lender will give you a more encouraging picture than just a general online calculator will be.
Right.
Because we can deep dive into your actual rate for that day. And that means a lot to somebody that's making a huge decision. When you're making the biggest financial decision in your life, don't go off generic calculators or monthly payments, because they're not your payment number one.
Right.
And there's way more options than what that is presenting.
There's way more options. And there's some potential snakes in the grass. Again, you get excited about, okay, we think this payment's going to be within our budget. And then you find out that what about flood insurance? What about homeowners insurance right now is really, in some areas, it has gotten out of control. There's been a lot of weather events the last few years.
Right.
Texas, we're in central Texas, obviously. We get pretty much every weather risk, maybe except hurricanes.
Depends where you are.
It depends where you are. Maybe we could get a hurricane. But I mean, so those insurance costs are part of the monthly payment. Right. And if you're estimating $100 a month for insurance, but it's really $250 or $300, and you're estimating $400 a month for taxes, and it's really $600, and you're estimating $100 for PMI, and it's really $300, well, then you're going to be hugely disappointed with that payment. It also works the other way, where you estimate this really high payment and you think, oh gosh, that doesn't fit my budget, so I'll wait. when in reality, there's a way to structure a lower payment. Again, we're pulling different levers. We're using money from a seller to buy down the interest rate, using money from lender contribution to buy down the interest rate, putting a little more money down, putting less money down, switching loan programs. We were talking about private mortgage insurance, and we have a show about PMI. I think PMI is not a 4-letter word. That was one of our previous shows. And we talk about the function of PMI. What is it? Well, it's insurance that protects the bank.
Right.
And so depending on which bank you're using, and I don't mean like mortgage company, I mean like program, right? If it's a Fannie Mae loan, if it's a Ginnie Mae loan, or FHA, VA loans do not have mortgage insurance. So if you're a veteran and you're getting a mortgage payment calculator, but don't realize that you're putting it into a conventional mortgage calculator, you're getting a wrong payment, right? So really getting a very specific calculator for your situation. That's really the message today. That's the takeaway.
Yeah, and I feel like everything else is really a disservice because it's just noise that needs to be eliminated, in my opinion.
Yeah.
If somebody's giving you a generic calculator of a monthly payment and it's not a lender for your specific scenario that pulled your credit with a soft pull or hard pull, then it's just hogwash.
Right.
It really is. It's not worth anything to you because it's not the real payment. Plus, it can go way up or way down.
Yeah.
And
a few years ago, the conventional loan pricing matrix changed, the interest rate matrix. We call them loan level price adjustments, LLPAs. We have an acronym for everything in our industry. It's like a whole new vocabulary. What we found with those new loan level price adjustments on conventional loans is every 20 points on your credit score matters. So it starts at a 780. That's the highest tier. So if you're an 800 credit score, or if you're a 780 or an 820 or whatever, you're the highest tier, right? 780, 760, 740, all the way down to 620. Every single 20-point increment is a different cost and or different interest rate on your mortgage. So how many tiers is that? 780, 64. It's like 8 or 9, 10 different
10 different
tiers.
Yeah.
So if you think your score is a 760, but that's your consumer score, and then your mortgage company pulls a 720, well, that could be a difference in your interest rate right there, which could affect your monthly payment, which could affect your budget, all those things. So that's the takeaway: is you've got to get accuracy. You really need to have a pre-approval with a mortgage company where they've run your credit, mortgage credit. We've looked at debt to income. Debt to income ratio can affect your payment. Well, how's that? Well, because the debt to income ratio on conventional loans can affect the cost of the PMI.
Yeah.
And if it affects the cost of the PMI, that affects your monthly payment. And all of a sudden, if you make $10,000 a month versus making $8,000 a month, the payment on the same house could actually be a different payment.
Yeah, and I don't want to, people might think we're kind of just being sticklers in this. And here's why this is important to a lender, is because we see people super discouraged when they're being given wrong numbers. So cash to close and monthly payment are usually the two biggest numbers people are concerned about when it comes to the price of the house, what it's going to cost them every month. And so if those numbers are way off from a general estimate, they're steering that buyer in the wrong direction, whether for it or against it in the wrong direction because the numbers are off. And this is why the federal government has stepped in and regulated our industry on marketing and advertising numbers and rates. And so because we have an MLS license, we had to go to class for it, pass tests. Every year we have to do continuing education, pass that every year. So we are a highly regulated organization. For us to advertise any kind of rate or monthly payment, we have to have caveats in there with an APR, and we have to have these little asterisks that explain how we got there. And so all that to say is when you see advertised rates from somebody that's not a lender and not disclosing APRs, then they're actually doing it incorrectly. And it's, the government has oversight committees that could actually find people and do all that fun stuff. We don't, it's not in our wheelhouse to tell other people what to do. We'll let the governing agents do that. But, it's the good intentions steer people wrong is my point. And I want the buyers out there to know, don't listen to those people. Listen to people that are actually licensed, because there is regulatory entities that make sure we do it the right way.
Yeah, a recent example of a client who wants to buy a home, actually found a really cool house this week they're putting an offer in. And when they were referred to me, right now they're paying $2,800 a month in rent. That's a pretty healthy monthly rent number, almost $3,000 a month in rent. And a traditional mortgage calculator, if you plug the numbers in and say, what loan amount equals a $2,800 payment? Well, in this environment, it's probably around $300,000.
Right.
Ish. But again, depending on the interest rates, depending on the home insurance, depending on the tax rates, PMI, all those things, we actually got them to $350,000 on the sales price with a minimum down payment, and their payment is less than what they're paying in rent.
Wait, that's different than what I'm seeing advertised online.
Exactly. The takeaway from the show.
How can you do that?
Yeah. Well, and again,
there are ways.
There are ways. And so when we're walking through the pre-approval process with most clients, we're getting to a point in the end result is getting to two numbers. What is the maximum you can qualify for? And then what's the budget-friendly number that you want to pay on a monthly basis? And so being very, very aware of your comfort level. What are your goals that you're trying to achieve? Well, I'm paying $2,800 a month in rent. I don't really want to go over that in a mortgage. Awesome. Okay, let's reverse engineer that. And then if there's a disconnect between sales price and payment, then we talk about how to bridge that gap through rate buy downs, through shopping our home insurance, maybe taking a higher deductible on the home insurance to get it cheaper so the monthly payment is lower. There's pros and cons to that. I have mixed emotions. It depends on your cash reserves. If you have a property claim and you don't have the cash to pay for the deductible, that's not a good thing. So we want to have a deductible that's reasonable, of course. So all those pieces of the puzzle play in. It's not just
that's an interesting concept.
Yeah.
I didn't mean to cut you off there, but like if you're doing or I'm doing a consultation with a client and we're asking what your monthly budget is for your mortgage payment, and they give us a number, like you said, we can actually reverse engineer the buying power options that stretch that monthly budget to its peak.
Absolutely.
Of like, okay, you only want to pay $3,000 a month in mortgage. Get it, totally get it. I'm there with you. So that means, your buying power ranges from here to way up to here, and that is a huge range, which is the opposite of a mortgage calculator, which starts at the purchase price.
Right.
Ours doesn't start at the purchase price. Ours starts at like, what's your monthly budget? And then we'll tell you the options of how to stretch that into a higher buying power.
Yeah. And then physically looking at the rate sheet with us. We have that full transparency where you can see all the different rates. And it's nerdy, it's geeky. we know we geek out on this stuff because that's what we do for a living. But having that interaction with a client on video where they're looking at the screen going, wow, I had no idea there were 30 or 40 different interest rates. I just thought, this lender has this rate and that lender has that rate. And that's the challenge with how our industry has failed. We have failed you as consumers, as an industry, because we put out a number and it's one of dozens of options,
one of 40.
Right? And so we're like shouting for the rooftops here, like, no, we don't have to structure it just one way. There's like so many different ways. And you had touched on before where you did a loan for a client that was an FHA loan compared to a conventional. It was like $300 a month difference.
It was $425 a month.
$425. Yeah. So same house, same borrower, same credit score, two different loan types, right? $425 a month difference.
Yep.
I mean, so could that mortgage calculator have failed them? Either
100%.
Way. Absolutely. If they'd have just gone and got the 100%. Got the payment online.
And people don't realize that, your credit score affects your conventional PMI rate.
Yes. Conventional mortgage rate and PMI rate.
Conventional, but I mean that one specific property mortgage insurance and actually has risk factors involved into its calculation on a conventional loan. On an FHA, it's fixed, the mortgage insurance. So everyone's getting pretty much the same kind of, there are elevated buckets, but the layers are consistent throughout of price points. Whereas conventional can be all over the map.
Yeah.
So, and that's where credit improvement is a great thing if you're doing a conventional loan. Big fan of that.
And that's another, we're looking for low-hanging fruit. We're
Yeah.
looking for those opportunities. A 739 credit score is an awesome score. It's not the same as a 740 in the conventional
that.
world. It can be the same depending on the down payment, depending on the different
Sometimes
factors.
it's as simple as when we pull the credit report because of how the utilization. If you have a $10,000 credit card and you have a $6,000 balance, but then we re-pull it again with a $1,000 balance, your score goes up.
That's right.
That's right. So it's just as simple as like, what am I paying my credit cards this month?
Yeah. Yeah, and that's a whole nother topic of most of us out there don't even know when our credit company is reporting the balance, and when they report the balance is how it affects your score. So even if you're paying your credit card off in full every month, and I'm using the air quotes because you might pay it off in full, but you're charging the card and using the card throughout the month, and when the statement cycles and you get an email saying you have a new statement from your credit card company, that's the moment they report the balance to the creditor. So at that moment, you could have a $2,000 balance when the statement cycles, but yet you paid it off in full, quote unquote, which that affected your score. So that's a whole nother. And so we are looking at that through a microscope, and where we can see those credit score improvement opportunities, we're going to take advantage of those, or at least suggest that to our clients, because that affects your credit tier, which affects your score, which affects your PMI rate, which affects your payment. And everything is all interrelated.
All right, we talked a lot about the things that affect it. What's our summary of this? Like, what do we want people to know about when they see an advertised monthly payment?
Well, I think it is, there's two takeaways. When you see a monthly payment and get excited and say, wow, I can buy a $400,000 house and I can have a payment of whatever, $3,500, $3,000, and that works for you, and that helps you take the next step and have the conversation and go deeper in the pre-approval stage, then that's a smiley face. But if you see a payment online and that same $400,000 payment calculator, and it says the payment's $3,500 or whatever, and that discourages you from taking the next steps because you think, well, gosh, that's too high, I can't afford that, then that just did you a disservice. So on one hand, it could be helping you take the next step to get good advice and find out, oh, there's more to the story, but at least you took that step. On the other hand, if it discourages you and you don't take the step, then you're not going to find out what the truth is. And so the mortgage calculator could work for you, it could work against you online. And I think the biggest takeaway here is you must talk to a true mortgage professional and go through the process. Apply online, have them run your credit, upload your pay stubs, do your W-2s, tax returns, get a full financial overview, right? Get a full financial picture, and then look at your options, and then reverse engineer based on your budget. And with full transparency, giving a lender your payment budget is not going to reduce your leverage, so to speak. I think there's kind of a myth, especially with maybe buying other consumer goods, where you don't want to tell them what your payment is. You give me the lowest price, and then I'll see if I want to take the next steps. And it's like it kind of works different with the mortgage, at least in our world, because it's fully transparent. You can see all the different. We work with multiple banks, multiple loan programs, multiple rates, and so knowing what your outcome, knowing what your goals are, then helps us diagnose exactly what the prescription is, right? And then we can say, okay, this is what we suggest. Here's a couple of options, and then let the math make the decision.
Yeah, I mean, if I was a betting man, which I'm not,
of course you are,
so much, all day long, it's all I do. Then I'm going to give you a rate and say this is going to be your rate. I can't do that, because your rate is going to be dependent on like 62 factors, okay? So number one, that number is wrong. Number two, 99.9% of the mortgage calculators out there are using a general estimator of a certain bracket of credit, a certain PMI, a certain estimate of taxes and insurance. 99.9%, that is not your scenario, right? So out of the gate, estimated monthly payments, that will not be your payment.
Yeah.
It just won't be your payment. And so the bummer is all these things are out there saying this is going to be your monthly payment on this home. It's actually not. So number one, they're not your payment. And number two, they have no idea unless they're a lender, of all the options that are available for you to bring that up or down.
That's right.
And you need a consultation, and honestly, you need an application to get that done, so that we can intake everything and verify and pre-approve the correct scenario for you. So all that to say is, it's just marketing.
Yeah. It really is.
It's just marketing, and it's, in my opinion, as a lender, it's bad marketing. And so I'm pushing against it because I'm like, I feel like it's doing more bad than good out there. But that's just my opinion. Other people will say it's doing more good than bad, and that's fine. That's their opinion. But because I do consultations with clients, I'm always having to correct bad information that they've gotten from other people. I was like, hey, they told me my payment could be this on this house. I can't, actually. Like, you have a 0.01% chance that will be your payment.
Right.
But good news, we can get you lower, or hey, good news, we can find a scenario that works for you. So all to say is, take it all with a grain of salt. Realize it's just marketing. Realize it's not the true number, and talk to a good lender, because that's how you get a true number.
Yeah.
You know.
Yeah, it's really important to get all the information. We've joked about this before about, would you jump out of an airplane without a parachute for $10,000?
Right.
And it's like, well, no, I wouldn't jump out of an airplane without a parachute for $10,000.
Right.
Well, what if it was sitting on the runway?
Right.
Oh, well, that was a piece of information that was left out. And yes, I would jump out of an airplane if it was sitting on the runway for $10,000. I might break an ankle, but so that's gather the information, get all the information, and don't just look at here's what this home price is, and here's what the payment is, when it's not customized to you. That's the biggest thing. Yeah.
Yeah, and realize that. So that's the simple version. Yeah. Mortgage calculators are not your calculator.
It's a good guide. I mean, it's a good guide on one hand, and if you have the sales price and you know what your credit score is and you put in an interest rate, and you can get a principal and interest number pretty easily, right? But that's 1/4 of the components of your payment, because you've also got taxes, you've also got insurance, you might have PMI, you might have flood insurance, you might have HOA dues, right? I mean, there's like 5 or 6 components sometimes to your payment. So the principal and interest, the note, how much you're borrowing, and the interest rate over 30 years or 20 years or however long, that is just one component. And so a lot of times that's what happens too, is the calculator just spits out the principal and interest, and it doesn't calculate the insurance and the taxes.
And people think that's their mortgage payment.
Yeah. So we've seen that before. Oh, it's $1,600 a month. Well, yeah, it's $1,600 a month plus the other components as well. Yeah. And we're always going to quote the full, PITI, right, with principal, interest, taxes, insurance, and then MI if that's applicable. And there's ways to get around PMI without putting 20% down on conventional loans. So there's some creative strategies out there that we use on a daily basis to help achieve the payment goal. The key is we got to know what your payment goal is.
Yeah.
So
that's a big deal. Yeah. There's a lot of moving parts that a lot of people don't know about either. I mean, when you're mentioning PMI, one thing that pops out to me is like, if you're getting a seller concession, then you can do, an upfront PMI cost.
That's right.
That gets rid of it for your monthly payment.
You can buy it out.
And stretches your buying power.
I didn't know we could get out of PMI by putting less than 20% down. You absolutely can.
You can.
Now the loan may have insurance on it, but you're not paying it. That's what we're saying. Like, there's ways to self-insure that loan, or have the seller pay it, or use a different program that doesn't have PMI. So and right now what we're seeing also is in this environment, because there is a push for home ownership nationwide, right? I mean, we know that there's aspirational homeowners at every market. And so the tools are kind of coming out of the toolbox right now in the form of social media.
Well, yeah, the quick and easy numbers, people want them. And I want them for everything I'm looking at online. So I get it. I get the fast shopping. The hard part is, because it's so nuanced in how our industry still works for your monthly payment, is address specific, number one, because we got to know taxes. I got to know taxes and insurance on that property. And so it is address specific, and it's person specific because of how your 62 items in your risk analysis work.
Right.
And so that alone doesn't allow any quick and easy numbers to work for you, because it has to be a comprehensive
right.
risk evaluation to get you the right monthly payment. And people don't know that. They want a number.
Yeah,
it takes time.
As an example, if you have two different first-time buyers or 10th-time buyers for that matter, but two different buyers, same property, same house, same type of loan, even conventional loan, and one income level is below a certain number or above a certain number, those income levels can actually change the interest rates because it changes the program, even though
we should recapture that, the 62 items that affect your credit.
Oh my gosh,
your credit rate.
So many. There's so many.
Yeah, but and again, I think that people don't realize, the property matters for the monthly cost because of taxes, and then every nuanced factor of your risk analysis is going to change your rate too.
Yeah,
I think that's good.
Yeah, and I think about this process, what we just talked to, like I think about our health. If you're not feeling well, if you have an illness, sickness, or gosh, like a family member, like a child. If you have one of your kids, if you're a parent out there and you have a kid who's not feeling well, they haven't felt well for a while, and you're sensing that there's something more than just, it's a headache and take 2 Advil and call me tomorrow. Like there's something more there. Yeah, you can certainly go. There's a lot of online sources where you could go to try to diagnose your own child if you're not a medical professional. Right?
Happens every week in our house.
If you're a medical professional, it's different. But you're most likely going to take your child to a professional to get them diagnosed. Right? Yeah. You're probably not going to try to self-diagnose for any length of time if it seems like this is lingering. Right? And so if you're going to take those steps to get a professional opinion, that's what we're saying. Get a professional opinion about your finances. This is the biggest purchase of your life, potentially, right? $300,000, $400,000, $500,000, $1 million.
I think that's a big deal. I'm glad you brought that analogy up because it's a good one. I was trying to find another analogy and I couldn't. And so if there's somebody out there that knows of a good analogy of how to do of what a risk analysis for a pre-approval looks like or a monthly payment for a borrower, because what's funny is the analogies are good for an upfront look under the hood, whether it's a doctor analyzing a patient, a dentist analyzing teeth, a mechanic analyzing a car. The difference is you're paying this thing every month for the life of how long you're in that house, whether it's 7 years. So not only is it important to get right, the size of it and the gravity of it is an every month repeat occurrence, and you want to get that right. And
then having we call it the Client for Life program. I mean, we have an ongoing monitor for a tag for every one of our clients. We do annual reviews and we're looking at insurance, and I'm having a lot of conversations right now. Escrow statements just came out. So for those of you that have not bought a house yet, when you own a home, every year your lender's going to reassess the taxes and insurance and your escrow portion of your payment.
Mine was short $2,000.
Yours was so was mine. My insurance doubled in the last 2 years.
Yeah,
home insurance.
Same.
And we have a second home property. That home insurance, I'm dealing with that right now. We just got a notice of non-renewal because we're in a wildfire area. It's in New Mexico.
Are you kidding?
And so the broker that we're using out there sent me an estimated quote yesterday. It is 2.5 times what it was. So we're in the business and we're living it. So we know our clients are living this right now with taxes going up. And taxes have been pretty steady for a couple of years, but home insurance costs have gone through the roof.
They've been hurting.
It's been rough. So we want to keep an eye on that. This is a mortgage these days. You don't just set it and forget it.
Nope.
The actual 30-year fixed component of your mortgage, yes, it's never going to change. But the other components of your mortgage can change. And so you want to have someone that's looking at that 30 minutes a year. It's all it takes. Just sit down, look at it. Is there something that needs to be addressed?
Have a conversation.
No? Have a conversation, and then you can breathe easy knowing that you're in the right spot. So so we're glad you're with us. I think we went a little longer maybe than we thought we would.
We did because it's more important than I think people realize to get that right number. And we're here for you to get that right number. And that's what a lender does. Yeah. So trust a lender, don't trust marketing. That's all I gotta say. That's the simple thing.
Exactly.
So
awesome. Well, please like, share, subscribe. We'd love to hear your comments. Anything that you would like to know more about, please let us know, and look forward to seeing you again next time.
All right, take care.